Investing can seem overwhelming for beginners, but it's one of the most powerful ways to build long-term wealth and achieve financial freedom. Whether you're saving for retirement, a home, or simply want your money to grow, the right strategies can make all the difference. We'll break down the best investment approaches for beginners, covering where to start, how to manage risk, and how to grow your portfolio with confidence and consistency. Today, we will talk about best investment strategies for beginners. So before we start, make sure to hit the like button and subscribe to my channel. Start with financial goals and a solid foundation. Before diving into any investment, beginners should define their financial goals clearly. Are you investing for retirement in 30 years, saving for a down payment in 5 years, or hoping to grow wealth steadily over time? Goals will shape your investment strategy, time horizon, and risk tolerance. Equally important is ensuring your financial foundation is secure. Pay off high-interest debt like credit cards, create an emergency fund with 3 to 6 months of expenses, and ensure your monthly budget can accommodate regular investments. Understand risk tolerance and time horizon. Your risk tolerance is your emotional and financial ability to handle losses. Younger investors often have higher risk tolerance due to longer time horizons, allowing them to recover from short-term market dips. Older investors or those close to their financial goals may prefer more stable, conservative investments. Time horizon refers to how long you plan to keep your money invested before needing it. A longer time horizon allows you to invest in volatile but potentially higher yield assets like stocks, while short-term goals, less than 5 years, might call for safer options like bonds or high-yield savings accounts. Learn the core investment types, asset classes. Understanding the basic asset classes is essential. Stocks, equities represent ownership in a company. They offer high growth potential but can be volatile. Bonds, fixed income, are loans to governments or corporations that pay interest over time, offering lower risk and more predictable returns. Mutual funds and exchange-traded funds, ETFs, are pooled investments that provide diversification by holding a variety of assets in one product. Start with low-cost, diversified investments. For most beginners, the best starting point is investing in diversified, low-cost index funds or ETFs. These funds automatically spread your money across many companies and sectors, reducing the risk of any one company tanking your portfolio. For example, an S&P 500 index fund includes 500 of the largest U.S. dollar cost averaging to build wealth, gradually. One of the smartest and most beginner-friendly strategies is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, e.g., monthly, regardless of market conditions. By doing this, you buy more shares when prices are low and fewer when prices are high, reducing the impact of market volatility and removing the pressure of timing the market. This strategy also builds discipline and consistency, two key traits for long-term investing success. Many platforms allow you to automate DCA by setting up recurring contributions, making it easier to stay on track. Take advantage of tax-advantaged accounts. Investing in tax-advantaged accounts can supercharge your wealth-building efforts. In the U.S., Roth IRAs and traditional IRAs are popular retirement accounts. A Roth IRA allows your investments to grow tax-free, and you can withdraw earnings tax-free in retirement if certain conditions are met. A traditional IRA offers tax deductions today, but withdrawals in retirement are taxed. 401k plans offered by many employers allow you to contribute pre-tax dollars from your paycheck, often with employer matching, essentially free money. Choose the right brokerage platform. To begin investing, you'll need to open an account with a brokerage. Look for platforms with low fees, user-friendly interfaces, good educational resources, and access to the investments you want. Popular beginner-friendly brokerages include Vanguard, Fidelity, Charles Schwab, Robinhood, and E*TRADE. Many now offer fractional shares, letting you invest in expensive stocks like Amazon or Google with as little as $5. Some also provide robo-advisors, automated investment services that build and manage portfolios based on your goals and risk tolerance. Don't try to time the market. Trying to buy low and sell high might sound smart, but even professional investors struggle to time the market correctly. Markets are unpredictable, and jumping in and out based on headlines or fear can lead to losses. A better approach is long-term investing, buying and holding quality investments over years or decades. History shows that the market tends to go up over time, despite short-term downturns. Staying invested through volatility allows you to benefit from compound growth and market recoveries. Ignore short-term noise and focus on your long-term plan. Understand the power of compound interest. Compound interest is one of the most powerful forces in investing. It means your money earns returns, and those returns earn returns over time. For example, if you invest $1,000 at an average annual return of 7%, in 30 years it will grow to over $7,600 without adding another dime. The earlier you start investing, the more time compound interest has to work in your favor. Diversify your portfolio to manage risk. Diversification means spreading your investments across different assets, sectors, and geographies to reduce the impact of any one investment performing poorly. A diversified portfolio might include U.S. and international stocks, large and small companies, bonds, and real estate. Diversification protects you from volatility and enhances your long-term stability. Even within a single asset class, such as stocks, diversification is key. Investing in different industries like tech, healthcare, and energy prevents your portfolio from being overly dependent on one sector's performance. Keep emotions in check. One of the biggest obstacles to investment success is emotional decision-making. Fear during market downturns can cause you to sell at a loss, while greed during booms can lead to risky, overpriced purchases. Develop a written investment plan outlining your goals, asset allocation, and contribution schedule, and refer to it when emotions run high. Avoid checking your portfolio daily. Instead, review it quarterly or semi-annually to make adjustments. If you find yourself panicking during market swings, consider working with a financial advisor or using a robo-advisor to maintain discipline. Rebalance periodically, but avoid overtrading. As markets fluctuate, your portfolio may drift away from your intended allocation. For example, if stocks perform well, they may make up a larger percentage of your portfolio than intended, increasing your risk exposure. Rebalancing involves selling overperforming assets and buying underperforming ones to return to your target mix. This should be done once or twice a year, not too frequently, to maintain your risk level. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.